The Red Sea crisis catalyzed a shift from efficiency-first to resilience-first operations, creating consolidation opportunities that acquirers recognize but ZIM's board deems undervalued. ZIM finds itself at the epicenter of container shipping's geopolitical transformation, rejecting a revised management-led takeover bid while fielding multiple competing offers. This is a high-stakes negotiation that reveals how regulatory weaponization and permanent route disruptions are redrawing the industry's power dynamics. The Haifa-based carriers board dismissed the management proposal as undervaluing the company, even as third-quarter earnings plummeted 89% to $123 million on revenues down 36% to $1.78 billion. Yet, CEO Eli Glickman struck a defiant tone, emphasizing the carrier's modern fleet and flexible deployment strategy as competitive advantages in an era of sustained volatility. That volatility has fundamentally altered the calculus for mid-tier carriers like ZIM. The Red Sea crisis, now entering its second year, has catalyzed a permanent shift from efficiency-first to resilience-first operations across the industry. Vessels rerouting around the Cape of Good Hope added 30% to voyage lengths on Asia-Europe trades, creating an estimated 11% surge in overall container TEU mile demand in 2024, according to UNCTAD. But the tactical advantages of this disruption, which temporarily inflated freight rates threefold and allowed ZIM to maintain profitability despite earnings pressure, are eroding. UNCTAD projects containerized trade growth of just 1.4% in 2025, with potential contraction depending on tariff escalation. By 2026, rate normalization looms as carriers deploy massive overcapacity built as geopolitical insurance rather than market optimization. ZIM's charter-heavy model exposes vulnerability during rate normalization. Despite Q3 profitability amid 89% earnings decline, the carrier operates with approximately 2% market share against 20% plus giants like MSC and Maersk. Also, ZIM's efficient, modern fleet attracts acquirers seeking adaptable assets without massive owned tonnage overhead during an era when flexibility trumps scale. Yet ZIM's vulnerability also creates strategic value. Multiple bidders recognize the carrier's modern, fuel-efficient fleet, including substantial LNG dual-fuel tonnage, as adaptable assets in a fragmenting trade environment. The company's Israeli flag offers neutrality in U.S.-China bifurcation, providing shippers flexibility that European or Asian-flagged carriers increasingly lack as maritime infrastructure becomes geopolitical leverage. ZIM's asset-light, charter-heavy model compounds the complexity. While this approach provided cost flexibility during boom cycles, it exposes the carrier to rate volatility more acutely than integrated competitors with larger owned fleets and diversified logistics operations. The company operates across 90-plus countries and 300-plus ports, but lacks the vertical integration that has become synonymous with resilience in contemporary shipping. The carrier's strong balance sheet, net leverage around 0.9x, and continued dividend policy signal underlying confidence. Since its 2021 IPO, ZIM has returned roughly $5.7 billion to shareholders, far exceeding capital raised at listing. This shareholder-friendly approach may reflect management's assessment that standalone value exceeds current acquisition premiums, particularly if geopolitical fragmentation sustains elevated rates longer than markets anticipate. Industry consolidation is accelerating precisely because disruption has become permanent rather than episodic. Carriers are building redundant capacity across multiple geographies not to optimize traditional supply-demand dynamics, but to hedge against choke point vulnerabilities, regulatory bifurcation, and infrastructure weaponization. This geopolitics-first logic makes profitable mid-tier carriers like ZIM attractive targets not despite their vulnerability, but because of their strategic positioning in an increasingly fractured maritime order. ZIM's upgraded 2025 guidance of 2.0 to 2.2 billion EBITDA reflects cautious optimism, but the carrier's fate may ultimately hinge on factors beyond operational execution. For now, ZIM's board is betting it can extract higher value by waiting.